Thursday, June 18th, 2020, Maneco 64, home of alternative economics and contrarian views. So today I want to talk about the pitfalls of these new trading apps, trading with leverage, trading with derivatives like options. And I know what I'm talking about because I was a futures and options broker. I started out, of course, as many of you know, at a small private bank in Geneva, Switzerland. Then I moved to London a few years later, and I was eventually employed by one of the biggest, or probably the biggest at the time, futures and options broker in London called GNI. I already knew about options back then, but as a junior employee in the business, GNI was a great firm. It made us learn about what we were selling to clients. I did courses about options. They even had an options handbook, which I read. So things were very different then. We didn't have these trading apps that we have today. Of course, there was no mobile phone, no smartphone. You called your broker, you spoke to a broker. Yes, you paid commission, but you paid for the service and the knowledge. And why am I talking about this? Well, there's a really sad story out. One of my viewers sent it to me yesterday. This is from Forbes. It says 20-year-old Robin Hood customer dies by suicide after seeing a $730,000 negative balance. I'm not going to go through the whole story, but I'm going to put it in the link and you can read about it. For those of you who don't know options, it's going to be very complicated. But let's first look at the Robinhood website here in the UK at least. It says invest in global companies in a whole new way. So it says no commission or foreign exchange fees. We take care of them so you don't have to. Well, what I think they do is they take a cut from the bid and offer spread. That's how they make their money. But do you think these people employ someone like me back 25, 30 years ago who used to be on the phone? And if the client had a problem, the client could call me and ask me, and I would know everything about what the client was doing. I would explain to him or her what was going on. No, they don't. It's just an app on the phone. That's the brave new world, right, of AI and nobody helping you, no human being. So no account minimums. That's another pitfall there. Get into the market with as little as £1. That's just crazy, my opinion. But I'm going to get to the story in a minute, and I'm going to tell you what happened. And it's really sad because this young man didn't lose any money, but he thought he did because he didn't know about options or what he was doing. No manual needed. There you go. No manual needed. You don't need anyone to tell you what you're doing. Intuitively designed for newcomers and experts alike. So being an expert doesn't matter anymore because newcomers will do the same as you do. This is just really irresponsible in my opinion. I'm not into regulation being the be all, but if you're going to regulate markets, do it properly. This is just very irresponsible, this Robin Hood. The other week, I think it was last week, I told you the story about my nephew who was a bit older than this young man in the States. He was 20 years old. He asked me about the trading apps and ETFs, and I said you need to be careful with those, with the leverage. You need to know what you're doing. And I said, preferably open a brokerage account with someone that you can talk to. And I had one of the viewers commented, well, why don't you give him the advice? You're the expert. And my reply was, yes, I can give him the advice, But if he's going to put his money with a brokerage firm or one of these trading apps, he needs to be able to talk to someone. And it's really amazing that I was telling him that pretty much when this was happening to this young man. And I think the biggest reason why he's dead, he committed suicide because he thought his account had a huge negative balance. And he thought, oh, my future is gone. I owe almost $1 million, $700,000. And he killed himself. But if he could have called his broker like a human being, John or Sally or someone, and asked them, sorry, what's this negative balance? And if the brokers, of course, had known also what people were doing, if they knew about options as well, they would have said, oh, don't worry, it's just a technical thing, but that balance is going to come away the next trading day. He wouldn't have killed himself. And if he'd known also about what he was doing, he wouldn't have been worried about it either. And this is where we come to the story. Basically, what he did was not a risky strategy, actually. And the other thing you need to know about options on stocks is that usually in the States, if you buy one option on IBM, for example, you get control of 100 shares. That's the way you need to look at it, that you have the equivalent of 100 shares of IBM, even though you don't have to put that much money down. You just have to pay the premium for it. So what he did is he sold what's called a put spread. The Forbes article talks about that he did a bull spread. Well, it's the same thing. A put spread basically is actually not risky. Let's say you sell the $100 strike in Acme stock and you buy the 95 put. So what's the point of doing that? Well, the point of doing that, let's say Acme is trading at 110, is that you take in the premium by selling the 100 put, so you receive the premium from the buyer, and then you buy the 95 put, you pay the premium to the seller. So you make the difference there. You receive a small premium, and that is credited to your account. And that's how it works. The maximum you can lose is the $5. If Acme drops to 95 at expiry, you lose the $5. But then you've gained the premium that you got for selling the strategy. So what I think happened in this case, and it's what Forbes thinks happened, is that the underlying stock of that option strategy went through the strike, the 100 strike, but didn't go through the lower strike. So what happened is that technically what you have to do at expiry is to basically buy Acme stock at 100, right? And whoever bought the put from you, the 100 put, they can sell it at 100 to you. What will happen though, technically, in the settlement of the trade is that they will debit your account for the purchase of those 100 shares of Acme. So that's why they debited the account of this young man by $730,000. But at the same time, when the trade settles the next day, and I think this was on a Friday, so the trade would have been settled on the next Monday, but they debited his account on the Friday. What happens on the Friday is that he will have also sold the stock, and he would have sold it at the lower price where the market was, and they'll settle the trade. He'll lose the difference in the 100 shares of Acme, but then the credit that he made from selling the strategy will also be credited to his account. So as he didn't know what he was doing, he didn't know about put spreads or what they call as bull spreads. he thought that he'd lost all that money. And if you knew about put spreads, you would have known that your loss was limited, and you would have known it before you put the trade on what your loss, your maximum loss could be, and that it wouldn't be a 730,000. That it was just a technical settlement thing of the trade. So and that's why it's important that you're able to call someone if you're new to the market, and you shouldn't even be doing these strategies if you're new to financial markets. It's called a broker, and the broker would have explained it to you. Oh, don't worry, this is going to come off your account because we're going to put a sale through as well through your account, so it's going to net out. This is just a technical process for the settlement of the trade. So this young man, Alexander Kearns, he saw that in his trading app on his phone, and he just killed himself for something that was actually not that serious. So that's why I keep telling people, if you are going to get involved in the markets and you don't know about the markets, that's the reason why you need to learn about options. It took me a few months once I started at GNI for me to, or maybe a few weeks for my superiors, my bosses, my heads of desk, to allow me to actually trade for the clients, let alone trade for myself. Eventually, though, I had my own accounts that I could trade with at GNI, and I did trade options. But you need to know what you're doing. So, yeah, the pitfalls of trading with leverage. I don't know how much this young man knew, Alexander Kearns. I don't know if he knew that each option he bought gave you the right to buy or sell 100 of the underlying shares. Maybe he didn't know that. He just thought, wow, let's do this strategy. I'm going to get a premium. And that's what he did. And so beware of these trading apps. Probably there are not many brokers left out there who you can talk to. If there are, they're like prime brokers. They're brokers for hedge funds or the very wealthy, and they actually talk to someone like me who can explain to them what's going on and what they're doing. So there you go. You're not paying any commission or anything, but you're not getting the service, and it might be even dangerous to your life, as we found out, unfortunately, for this young 20-year-old. So there you go. Let's look at things now, the markets, what's going on, what I've noticed. Well, first of all, I'd like to say that a month or more ago, I sent a letter to the White House. I contacted the White House trying to get through to President Trump about the craziness of the monetary policy of what the Fed's doing by printing all the money. So I sent them a letter. I didn't get a reply about what I wrote, but they've put me on a list. So I keep getting letters or emails from the White House. And I've noticed, and many of you have probably noticed as well, that there's a lot of push now for a second wave of this health crisis, especially in the mainstream media. Publications like the FT, Bloomberg, the Times of London, the Telegraph. There's a huge push. Oh, China has got new cases, and then you read about China, and they've got about 40 new cases in Beijing, in a country of 1.4 billion. So they're really pushing this. So yesterday I got a letter from the White House, and it took me to this piece written by Mike Pence, Vice President of the United States, June 16th, as you can see, and it says, there isn't a coronavirus second wave. So it looks like there's a battle there between the White House and the mainstream media. What about Mike Pence? I know that Mike Pence I know that Mike Pence is running this task force, but I've watched also Amazing Polly's videos about Mike Pence. People like Dr. Fauci, they've worked together before. So I don't know what to think, but there seems to be some kind of conflict here between the administration and the mainstream media and everyone else, right? So this is what the White House is trying to tell people. Don't worry about the second wave, right? And then we have the mainstream media saying, worry about the second wave. So just thought I'd put that through to you there. I found it interesting. I mean, you can go to the White House website and read about it as well if you want, and believe it if you want, or believe the mainstream if you want. I think it's all very, very up in the air still. I think they have a real agenda, and even if we don't have a second wave, we're going to have something that's going to keep us the way we are, especially here in the UK. Yes, we hear from specialists, from Dr. Vernon Coleman, which I highly recommend his videos. I'm going to put one of his videos up in the card and below in the description. You should really subscribe to Dr. Vernon Coleman. He's a British doctor, and he talks a lot of sense. So, and now I'm seeing also this story about Donald Trump asking Xi, the president of China, for election help. John Bolton, the neocon warmonger, has come out with a book. So the division is there. It's continuing, and that's not a good thing. The division everywhere around the world, domestically, but I think the U.S. is the most divided nation, I would say. So today we've got the Bank of England meeting. They're expected to increase their QE by another £100 billion. That's out at midday London time. That's when they will announce it. They're not expected to cut rates. Well, rates are at 0.1%, so they can't cut much further. They might cut to zero, who knows, but it won't make a difference. So let's quickly look at where the markets are. Yesterday, the stock market was down. The Dow and the S&P, they were down about 0.5%. Or thereabouts. NASDAQ was slightly higher. So right now it's 8:45 a.m. London. We've got spot gold at 1727.50. That's unchanged. Range has been 1723.50 to 1730. Silver's up 5 cents or 1/3% at 1755. The Dow is down 70 points. The Dow futures, that's a 1/4%, just above 26,000. The S&P 500 future is at 3107, down just 0.2% as well. The NASDAQ 100 future is unchanged. The currencies are pretty much unchanged except for the pound. The pound is down 1/3% versus the dollar at 125.15. WTI crude is at 38.03, down 1/4%. Finish off. Let's look at the bond markets. The 10-year yield is down 2 basis points at 0.713. Yesterday, there was an auction of 20-year Treasury notes, and apparently the demand was really big for it. Why? Well, because the Federal Reserve is making sure that people are not scared of buying bonds, because they're coming right after, probably today, they'll buy those bonds, right? We know that Treasury bonds, gilts, all those bonds are IOU nothings, right? There's nothing behind them except, of course, the power of the state to tax you. That's how they back the currency, through your taxes. And that's why it's so important that they tax you. Some people think that they could just print the money, but that's a subject that I'll bring up in another video. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.